Hello and welcome to another financial analysis video. Today I'm just doing a peer analysis of some of the big banks in the S&P 500, and as you could see from this chart, all but one of those banks year over year have share price declines. A lot of the notable names: Bank of America, Citigroup, JP Morgan is practically flat, PNC, Wells Fargo, all showing declines year over year. This bank, PBCT, interestingly enough, is the only bank that has shown a share price increase. It also is the highest dividend yield of these big banks in the S&P 500. And one of the things now that we're seeing is, thanks to this price pressure, we're seeing some of these yields come up and actually offer some income opportunities for investors amongst the banking sector. I also wanted to take an opportunity and just kind of show you. I'm going to move this over here. This was a week ago. I took this image a week ago of the RSI. This is the relative strength index of the big banks, and they were really getting hammered. They were getting hammered ahead of the first round of earnings, and since then the RSIs have actually improved slightly. Here they are, but at the same time, like I said, share prices for all the big banks still down, and really what it comes down to is a lack of earnings. The interest rates aren't rising as fast as they should, and for the most part, these banks are seeing sluggish or just non-existent earnings growth. Also, you have some banks like Zion over here that are exposed to energy loans, and that fear is causing the price to come down further. But what's interesting here is that we're seeing some pretty compelling value plays begin to open up with banks. I mean, JP Morgan, that is a pretty solid best of breed bank. It's now trading at 10.5 times forward earnings. That's just an unbelievable PE ratio for a bank like JP Morgan Chase. And so as a result, you're beginning to see some valuation metrics emerge in this entire group. What I want to warn investors from doing is just picking one like a Citigroup and going with it because it looks to be the best. Do your homework in these individual banking segments and sort of see what's going on. Here, the argument would be that PBCT would be the least responsible pick, yet you're getting a 4% income if you buy that stock today. So there's sort of some compelling stories going on here. However, and I'll show you the leverage just to show you how far things have come down from the financial crisis years. There's still a lot of fear in this sector. There's fear of the energy loans going bad, and there's fear that interest rates will never go up, which we know isn't the case, that it's eventually going to happen. One last metric I want to show you, and that's return on equity. I like return on equity in this space better than return on assets because return on assets is virtually nothing in the banking sector. Return on equity shows you which stocks are, in my opinion, more likely to generate book value growth for the investor. And U.S. Bank has been leading this now for about 6 months. And what's interesting is their number used to be up in the mid-teens, and it's now been just slowly and surely sliding. But Wells Fargo is still there too. And so these pair of banks are good, in my opinion, at generating sustainable earnings for shareholders. So do your homework and look at what kind of stock do you want it to be in. Again, income, PBCT is probably going to be your best bet. Return on equity, you've got U.S. Bank, you've got Wells Fargo. Forward earnings discounted, if you really believe in Citigroup, now would be a good opportunity. JP Morgan, KeyBank, they're all at low metrics. So this is just a starter to get you going on the big banks and how their metrics are looking. I hope you enjoyed this video. Happy investing.